And Katie, I know you'd been concerned about the way the technology stocks were kind of showing leadership to the downside, but that seems to have abated a little bit. What are you reading in the charts right now?
Well, really, it's as of this week that we've seen some relief for those large cap technology stocks. And I do think it's promising. They did exhibit downside leadership in the early stages of this pullback, which still does have a hold on the market in terms of short-term downside momentum. However, as Mike mentioned, we do have a very widespread short-term oversold condition now. And also, we've seen for the first time during the pullback, extremes registered by both measures of breadth and sentiment. So that, to me, is getting us much closer to a short-term tradable low. And, of course, those tech stocks, if they stabilize, that should set a better tone for the broader market.
You're not necessarily to the point where you would tell people to jump back in. You're waiting for some other signals first?
That's right. So I'm looking for momentum to turn. I think it's right to be somewhat conservative in terms of re-entering the market here, waiting for those momentum gauges to flash buy signals, if you will. And that, to me, is going to be the all-clear signal for at least the intermediate-term uptrend to resume. We don't have that yet, but what we do have is support discovery. We're seeing, in some cases at least, successful tests of the Monday low. So that's about 32.30 for the S&P 500. We're also watching Apple, Microsoft, and the likes come right into support on their charts and become very oversold there. So now once momentum turns, we'll feel better about getting back into the market. But as it stands, I think we can at least be reducing market hedges and covering short positions that have that same oversold condition.
Katie, is it somewhat positive, and it's with the benefit of hindsight, and if we were where we were 7, 8, 9 months ago, I mean, the S&P now is consolidating at what would be considered really positive levels based on everything we've been through. I mean, if we're doing work sort of building a base or consolidating gains way above 3,000 on the S&P, that just seems like that's kind of a win, although if that doesn't indeed happen, I mean, that would at least mean we're not back at 25 or 2,600 in your view if there were a second wave or a complete slowdown in the recovery in the global economy. I mean, that's possible given something negative happening, I guess. And that could put us that could put us back in the soup. You don't see that happening.
Not right now, not in the charts. So, I mean, there's certainly a lot of risks out there from a macro and fundamental standpoint, and of course related to the virus. However, the win is that the market still is in a long-term uptrend. Ahead of this pullback, we saw widespread breakouts, and those breakouts do tend to foster additional long-term positive momentum. So we're not seeing any structural damage to those long-term uptrends. The pullback has only affected our short-term gauges for the most part. Even the intermediate-term gauges are still pointing higher. So we don't see any issues in terms of a prolonged corrective phase at this time. Listen, anything can happen. We're expecting it to be a little bit of a bumpier ride between now and year end, certainly than we saw from March through September. But we're not looking for any major correction at this time.